Scott Forehand, welcome back to WNIS, my friend.
General Lee Foster.
I am here.
Very good to see you again.
Here's my salute to you.
Yeah, thank you very much. And we have a special guest today. We've got Drew Woodley, who runs our Albuquerque office, coming in to help us out today. Thanks, Drew.
Good morning. Happy Saturday.
Happy Saturday. Right on. All right, so let's see some news. I'm going to be a granddaddy.
Ooh.
Yep, that just happened.
Congratulations.
I'm very excited. I can't wait to spoil that child. It's going to be a good time.
That's right.
I've already bought the first and the second gifts I'm going to give them. The first one was a drum set, and this is just me trying to get back at my daughter a little bit. And then the second one is going to be a trombone. Yes, a trombone for the win. It's going to be a trombone because they have to have low brass. They need low brass in their lives, and that's what I'm. Were you a low brass player?
Trumpet.
Trumpet. Well, that's high.
That's high brass. That was close.
Yeah. See, all the fun happens in band in low brass.
This is true.
Yes.
Or
Yeah.
in percussion.
Oh yeah, yeah, definitely.
All the drum kids were always goofy.
Yep. Very good. Drew, were you in the band?
I was always in the band in my own mind. I personally think I can sing. I've been told I cannot, but I'll keep doing it.
Okay. So has anybody ever asked you what you did with the money your mom gave you for singing lessons?
Well, I tend to like to bang some drums.
Oh, okay. All right.
I guess I kind of just diverted it.
Very good. All right. So there's the first news, Lee. And the second news is my wife and I just moved. And so today was the first day that I've actually had to drive, quote unquote, into work from our new house. And it was an hour and 36 minutes from down in Edenton. So it's
Beautiful.
It's a beautiful drive, and
Yeah.
got to see the sunrise this morning over the lake where we live now, and it was gorgeous and no complaints whatsoever. It was a great move for us. We're still obviously unpacking everything as we go. But it's been a good time.
That area is such a gem.
It is. It really is.
It's beautiful.
Yep, it's gorgeous there. And if you ever get a chance to just come down, hang down Edenton for a day, there's great restaurants and lots to see, and the lighthouse is gorgeous. And yep, good stuff. All right. So Lee, what do we usually do at the beginning of the show of these shows? What's our first thing?
It's the State of the Union.
It is. It's charts.
It's chart time.
We're going to talk about some charts.
Yes.
All right. So. Yeah, Drew and I had a little bit of a conversation earlier about some of these things, and Drew's going to add some color in as I go forward and go through these charts. The very first one we're going to look at is what's happening in the market. And we have what's happening right now. People are starting to take profits off the table while they still can, because there's this pending fear of a recession. And maybe even moving into a depression. And what we're seeing now is we just saw, just in February, we saw a 7% sell-off, greater than normal. That means that people are starting to take some money. In the past, to put this in perspective, in the past 23 years, there have only been 3 times of 23 years where the sell-off was greater. Every single one of these previous ones, we had one in 2011, 2012, which kind of heralded the 13 drop. We had one in 2000 that heralded that drop, and we had one in 2022 or 2020, right at the beginning of COVID, that heralded that big drop. So we are in line with seeing a pullback in what we've seen in the past, and that chart kind of confirms that suspicion. It's not. There's nothing in charting that's a guarantee, but 3 out of 23. That's I like those odds if you're betting on a pullout. And I think that with Brian on just before us, with Mockimer, that the stuff that he was talking about and the transitioning from a gold standard off of that, and then transitioning to what Trump has already kind of said in advance, that he's right. I think that there's probably going to be a new sheriff in town as far as that stuff is concerned. It's probably going to be crypto, and with President Trump saying that it's going to be that we are going to be the first crypto superpower. That's really, if you're in the crypto market, that should be very exciting for you to hear. And this is kind of, I think, where a lot of this money's headed. It's being taken off the table, but it's not disappearing. It's going somewhere. And if we look at the banking industry and the lack of growth of the banking industry, that means the money that's coming out of the markets isn't going into the banks. It's going somewhere else. And that's probably where it's headed. It's probably a lot of it's going into crypto. So the second chart I want to look at, and this is, it depends on what kind of a person you are with relation to your retirement. This is talking about volatility. And we can see that we've got on this particular chart, we have a wide level of volatility, a lot of volatility happening right now. And if you're a day trader, or if you're even a weekly trader, that's a good thing. Volatility is good because movement in the market is what we want. We don't care whether it goes up or down. We just want movement. But if you are someone who's using this or has positions for retirement, 401k, 403b, TSP, KEO, SEP First, any of those, a 401a, defined comp, defined benefit, any of these programs, if you've got money in any of those programs, volatility is not your friend. Especially if you're getting close to retirement. And then Drew and I were just talking about that a few minutes ago. And Drew, I think that, what's your take on that? You have an opinion?
Well, I've been running into a lot of talk surrounding investments right now. People are worried. They're trying to invest a couple of years before they retire. And many don't understand that life insurance is much more than leaving behind a death benefit when they pass, which is why I'm so excited to have this conversation with you and talk about other ways that we can kind of secure money,
Gotcha.
Grow money in a way that's risk-free, and keep everybody stable and protected.
Right. So you're talking about really the creation of private pensions, especially for versus traditional retirement streams. Especially if you're looking at near-term retirement, and you're also talking about infinite banking, if you're talking about a little bit longer term, longer horizon before retirement. Does that sound right?
That's correct. Yeah.
Yep.
With a bit of understanding, it becomes a no-brainer, especially where we're at.
Yeah. So this volatility conversation, I don't, if I'm looking at banking on my money having a steady trajectory of growth, I don't want volatility. I want a linear growth rate. I don't want up and down, up and down, up and down, because in the up and down piece, where we're really influenced by the level of volatility, if we happen to call it wrong and we try to get out when we're at the bottom of that volatile cycle, we're probably not retiring, and we're probably having to go get a second job while our money makes it back just to where it was before. That's the power of loss. The power of loss is greater than the power of gain.
Terrifying.
If you have a 10% loss in your portfolio, how much does it take to get back to even? The answer is not 10%. It's like 11%. So you have to make back more than you lost just to break even, and that's before you calculate in the effect of inflation, the effect of the dollar, the loss of value at around 3% per year. So if you're looking at a 10% loss in year one, in year two, to make it back, you don't need 11%. That's gonna let your ledger show equal. That's not really the buying power isn't the same. You need to have 3% on top of that. You need to come back 14% to be even to what you had last year. And that's the effect of the power of loss compounded with the power of inflation. And so that's unfortunately what some people did. They don't take that into consideration when they're looking at long-term performance of their retirement systems. And that's part of what we do. And I know that you Drew, are really good at, and that's why you're on this call today. So thanks for acquiescing and joining me today. All right.
Well, I thank you, and I'm gonna do it. I'm sorry. You're real humble. I know you hate this, but I am honored to be on today's show with the Scott Forehand.
Stop
and
it.
Just so happened to be my mentor,
All right.
and there's no better mentor I could ask for.
All right. Let's keep going. All right. All right, so now we're going to look at the third chart, which is this is about credit spreads, and this is something that whether you know it or not, if you're invested and you have some money invested in a hedge fund or in a bank or any of that stuff, credit spreads affect significantly what you're going to make, and this is good and bad. There's two sides to this coin. If the credit spread is high, that means that the banks are making good money. That means that they're engineering arbitrage. They're borrowing money at the federal funds rate and selling it off or lending it out at a higher fund rate, at a higher rate. That's the credit spread. And if you're in their pocket, as if it were, if you have money in their bank and they're lending out your money, they're making a lot more. That to take away from this is, from a lending perspective, not bad. But here's the thing. It doesn't match what the market says. Because the market, if you look at the big banks, Bank of America, JP Morgan, even Truist, PNC, Wells Fargo, if you look at their market price, it's not indicating that the credit spread is affecting their bottom line in a positive manner. And it should be. So that means there's something else going on. So I think maybe what's happening here is while the credit spread yield is increasing, which should be a positive thing for banks, we're also seeing what we talked about in the very beginning, the sell-offs. We're seeing that the money's leaving the market, and it's not going into the banks. It's going somewhere else. So again, I think the crypto conversation is something that should be had with you and your financial advisor, financial planner. All right, Drew, we talked a little bit of time on this next one. This is about the correction territory that we're in.
The correction territory.
Yeah. So in the short term, a correction is absolutely needed. Jamie Dimon said it. The market is overpriced 20+%. Every time we ever get to this point in the past, there's usually a correction. Sometimes a correction happens over a period of weeks or months. Sometimes if it's a big correction, like in 2008, it takes 5 or 6 years. Or if it's a massive, massive correction, like in 2000, it'll take as long as 13 years. That's the same level of correction that's needed that happened back in the market crash, back in the 1920s. That's kind of where we're at, folks. Here's something that should be a little concerning. We have had a 10% drop in the S&P from its high in February. We've had a 10% drop in less than a month. That should scare everybody. And if you are scared, that means that your money's in the wrong place. Drew?
So I've been sounding the scary alarms,
yep.
Right? Not to terrify everyone, but to get everyone to start thinking so we can have this conversation before it's too late.
Yep.
One comment I've gotten is, well, it's going to be fine because we're engineering this. I'd say it doesn't matter if I hit your car on purpose or if I do it by accident. We still have a big problem. What do you say?
Yeah, it's a great analogy, right? But there's something that you can do, right? Why don't you move the car before it happens, right?
Especially if I'm letting you know, hey, I'm going to hit your car. So that's where we're at.
Yeah.
And I think people need to be scared because it's probably your only hope of being okay.
Scared to the point, not to the point where you're losing sleep every night, because there's things you can do, and that's kind of what what we offer, these strategies and these options here, where we can take the money off the table, and if we're wrong, and the market turns around and goes up, great, you're going to go up with it, and if we're right, and the market continues where it's going, guess what? You're not going to lose a penny, and that's kind of. This is an old adage, an old cliche. When we get close to retirement, 50, 55, 60, when we get close to retirement, the most important thing is the return of our money, not necessarily a return on our money. Because if we're making a retirement plan and we want to know how much we're going to be able to take and for how long, and is it going to last my whole life, and all those questions that everybody has when we're looking at retirement systems, it's hard to do if your money's based in the market. even if you're looking at a retirement plan that offers a 5% withdrawal per year, let's talk about that for a second. 5% withdrawal per year. What's the average return on the S&P over the last 20 years? It's 5.8, 5.9%. Okay. And if I'm only taking out 5% per year, that means I'm still making a little bit of money, right? The answer is maybe. Because that 5.8, 5.9% per year, that's an average over 20 years. There were 3 of those 20 years where the market dropped 20+%. And if the market drops 20+% the year before you retire, that destroys your 401k. That destroys your IRA. That destroys your TSP. Unless you're in an all-cash position. And if you're in an all-cash position, you're not getting 5% growth per year. So that's why when we start looking at retirement plans, there needs to be a component of your strategy that's not linked to market performance in a down model. If the market goes down, I don't want to lose money. I want to play the game by a different set of rules. I want to play the game by a set of rules that says, hey, I'll play if the market wins. But if the market loses, I don't want to play anymore. I'm taking my ball and I'm going somewhere else. So
and then for the fun question, you mean you can do that?
Oh, yeah. Yeah, that's a part and parcel to what we do. And that's why these private pensions that we do a lot of today have become so popular, because it allows that certainty that people have a problem with. I can't, if you're in a 401k, I can make guesstimations of where your money's going to be based on market performance. Has anybody ever heard that past performance does not dictate future performance? That's the truth. Over time, 40, 50 years, you can make some assumptions that the average is going to approach if you have that length of time. But if you're looking at retiring in 3 or 4 years, you have no idea. You have no guarantees that that money is going to perform the way that the market has performed over the last 20 years. We don't know. And if
I'd like to,
go ahead.
Sorry, I'd like to take it a step further. You know, it also depends on the day. So let's say the market is great on Monday.
Oh, yeah.
You withdraw your 401k. It takes them a couple of days to process. You're expecting a set amount. All of a sudden, you get your check, and it's 30% lower than what you expected. You call up your 401k company, and you ask them, you know, what happened? And they say, oh, well, I understand the market was up on Monday, but by the time we got the money to you, it was Thursday, and the market dropped. So there's literally no certainty.
Yep. So that's why when we are looking at, if you're 25, 35 years old, okay, you're fine. Whatever you can't really go wrong because you've got the effect of compounding on your side. There's something you should be doing other than a 401k. We can talk about that later. But if you're getting close to retirement, so you should take some money off the table, not take it all. And this is just kind of general anecdotal information. Certainly, I'm not giving any kind of investment advice over the radio. We'll have to have a conversation one-on-one to do that. But it is advisable to take some money off the table, put it in a place where you can't lose, where you have the ability to get a guaranteed income stream that you know. I just did this for one of my clients down in Florida, and his focus was he wanted to generate a $300,000 per year income stream. And where he was going to be at 114. And we had to do some other things and do some manipulations and involve some real estate transactions and a couple other things. But we were able to get him to where he wanted to be because we can use programs with guaranteed returns, not programs that are subject to some kind of market oscillation. So again, in summary of this particular chart, sorry, I just want to get back to that before I want to finish this and move on. We are in a correction period right now. The market is correcting. S&P's lost 10% in a month. That's a lot. And where we are headed, it doesn't show. The market doesn't indicate that the floor's been met yet. So this is a correction. If the market goes to where it should be, according to Jamie Dimon, somewhere between 20 and 26% should be where we end up. I don't think it's going to go that low, but again, Jamie Dimon's where he's at, and I'm at where I'm at, and he's done a little bit better than I have, so I'll take his word for it. Next, this is critical. You keep hearing all these stuff about the unemployment and the revised unemployment results and all that stuff, and where unemployment is right now, it's near its high. For the year, it's about on par with where it's been for the last maybe 8 months. It is at 4.1%. That's a lie. They're going to revise this again. They're going to have to, because once you start taking into consideration what's happening with Doge and with the massive amounts of federal government employees that are retiring, taking severance and getting out, taking early retirement, or being just fired, there's this number's going to go up, and it's going to affect things on a national level. And so while some people that are proponents of Doge, I mean, nobody wants to pay for frivolous things. Nobody wants fraud, waste, or abuse. Nobody wants that. Okay, but it is part of our government right now, and for whatever it's worth, it does feed into employment. It needs to be corrected. I'm 100% in agreement that needs to happen, and they will. But there's going to be, and they were saying this from the beginning, and this is proof. It's going to be painful for everybody in this country for a little while, and then we'll get through it. But that's where we're at. 4.1% unemployment. It's on the rise, and it's actually not real. It's going to be high. Go ahead, Drew.
So unemployment, right, tracks who is collecting unemployment, but a lot of these employees are actually not on unemployment.
Right.
So that number is going to go up. That's more money
Yep.
that's not going back into the economy. So we're going to see.
Yeah.
We're going to see it. We're going to see it.
So let's say you have a federal government employee that takes an early retirement package. Okay. And they're not old enough to collect Social Security yet. Okay. Are they going to sit there making $0? No. So they are an employee somewhere that is unemployed, but they're not showing up in that number. And that's kind of what you're talking about as an example. So yeah, you're right. All right. Next, Consumer Price Index. Okay, this is good. The Consumer Price Index is down to the lowest it's been since April 21. That's a good thing, right? That means your dollar is going a little bit further. That means that regardless of what Jerome Powell says, what the Americans feel is when we're going to the grocery store, what we feel, it's similar to the rate of increase that we felt 4 years ago. That means it's settled down a little bit, which is good. I don't think it's going to stay that way. There's going to be a reckoning that's coming, and the price of eggs, that thing that everybody points to, that had nothing to do with inflation. It had everything to do with the fact that there was a bird flu breakout and they had to kill a bunch of chickens. And when you supply and demand, if there's low supply, if there's high demand and low supply, the prices are going to go up. That's what that was all about. All right, next, S&P asset class. This is following track with the fact that we've seen a reduction in the S&P over the last month. But here's the thing: when you look at this chart, there's some charting bumpers, if you will, bumpers like in a bowling alley. Okay, that the numbers should move in between these they're not arbitrary. They're calculated limits, low and high limits. Well, it's busted way through the low limit, and it doesn't show that it's going to stop. So I think that we are going to continue this downward trend in the market. And for confirmation of that, if you look at that, Drew, the last one, this is the eighth chart we're going to review, and then we're done. Composite, last 24 months. The last time we met, which was in February about this time, where we were at the bottom level. We were at, there's a zero middle, and there's a little bit less than that, and that's the range that this particular index usually moves. What I said at that time was that the chart was indicating that it was going to go through that. It was going to continue on a downward trend, and it certainly did that. Now it's reached all the way to the bottom of the chart. In the last year and a half, it has only been lower. The S&P Technical Composite has only been lower one time. And this looks like it's going to blow through that lower floor that we had before. So this might be the correction that everybody's been holding their breath for, which is short-term painful, long-term really beneficial for everybody. Unfortunately, for those of you that are looking to retire, it means you're going to have to, while you're riding the market down, you're going to have to ride it back up, which means that you're going to experience the power of loss, unfortunately. There is a light at the end of the window, or excuse me, a light at the end of that tunnel, though. And this is something that Drew and I, we do all the time. This is talking about those private pension programs. So if you had the option to step off the train that was driving down and step onto another train that was going to stay level for a while and then ride it up when it rides back up, you'd probably do that every day of the week. If you don't want to go all the way down into the chasm because you don't know how deep that chasm goes, save what you have now. That's what we talk about a private pension. And these are rollovers. This is all we're talking about is a private pension income indexed annuity. And these are tools and programs that do exactly what they're supposed to do. They make it so you can't lose money, and you can only make money, and you do make money when the market makes money. And this is a tool that people should have in their portfolio. It's not the only thing. People should be diversified. I'm a firm believer in diversification, but this is a tool that we can use to help people get their retirement system stable.
And the results are tremendous. Honestly,
Oh, yeah.
It sounds like we're losing a lot in what we can gain, but that's not the case at all. In fact, we gain a lot more, and we do it in a safe way, and you know what's going to happen at the end.
Yeah. Yep. So that's one of the tools that Drew and I usually talk about, and we're going to talk about some more in just a minute. And I'll leave you this: what's the difference, or what are some of the benefits of dollar cost averaging, and what are some of the problems with dollar cost averaging? We'll be back in a minute.
And of course, every time we do a radio show, the following Thursday, you do have a class.
That's right. We have our Infinite Banking and Debt-Free Life class, which is going to be on Thursday at 5:30 via Zoom. You can call, if you're out of the area, you can call that toll-free number and get a Zoom invite. And if you're local, you can call the 278-1264 number and get an invitation to that class. It's about 90 minutes long. The first 30 minutes is a presentation about how infinite banking strategies work, and then we'll usually have a special guest on, and then we'll do some advanced strategy in the end, like how to use it to pay your taxes, how to use it to retire early, that kind of stuff.
Who's a special guest this week, or is it a secret?
It is a secret.
Ooh.
Yeah, you'll have to show up and find out.
Okay. All right.
Yeah.
Forehandagency.com or 757-278-1264, 1-800-677-0989.
Very good. So we were talking on the break, and I wanted to give Drew a minute here. Drew, tell me, you've got some perspective on some of the things that we've been talking about. What are your thoughts? Let's hear it.
I do. And, Scott, I'd love to talk to you right now about something, because I think we pass over an extremely powerful tool, and that's an annuity. And when I talk to people about it, sometimes they've got a bad taste in their mouth because they've only ever heard it in reference to a variable annuity.
Right.
And that is not what we're talking about right now, right?
Right.
But most people are in a position where they're going to run into one of two problems. Either you die too soon, or you outlive your money, and that's scary, right? So for some of our new listeners, when it comes to annuities, I always like to give the example of Jack and Sue. Jack and Sue have money. They put it into the bank, right? What's the problem with that? Well, when you spend it, it's gone, and eventually they will run out. But if Jack and Sue put that money into an annuity, the carrier would then tell them, thank you, and based on your life expectancy, this is what you can withdraw every month. And they're going to give them a lifelong income stream that they can't outlive, even if the amount that they're receiving surpasses what they've put into it.
Beautiful.
Originally.
Yep.
And then it gets even better. If Jack passes away, the money goes to Sue. So it becomes a no-brainer, and it's such a powerful tool if understood properly. So I really want to have that conversation and kind of discuss how it can be used and what the importance is of understanding these things.
Right. And just in reference, variable annuities They're called variable because they can go up and down. They can lose money, and that's why in our practice we don't use them. We don't. We have the capacity to. We've got a bunch of carriers that would love us to, but we don't use them simply because we are able to say that for everything we've ever done for our clients, we've never lost our client a dollar, a penny, and that's because we stay away from those products that have loss potential. And that's just kind of how we do business. Again, that goes back to that. I'd rather have a return of my money than on my money. That's it. We're not putting people in a position to lose money. And I love that you were bringing that point to light, Drew, about the fact that the annuities that we use are designed to provide income streams, permanent income streams, and they can be structured to take out an income stream for a period of time. 5 years, 10 years, 20 years, or for the lifetime of the individual. And then with survivorship, which is what you're talking about for the spouse, it can go on to exist beyond the length of time of the original individual. So that's good stuff. So, Drew, what I want to get into now is that question before we got off the air. We said, what's some pros and cons about dollar cost averaging? So first off, we have to understand what it is. And so we had a TV appearance a couple of days ago. We talked briefly about dollar cost averaging. I told people on that show I'd complete the conversation here. So dollar cost averaging is a method of investment. It is something that is used over a lengthy period of time. It is not something to be used for the short term. It is not something that you're going to see a return or any of the main benefit of a dollar cost averaging schedule or plan. You're not really going to see that in a couple of years. So if your retirement horizon is 3 to 5 years or shorter, that's not a tool for you. That's not something you should be considering. That's a long-term investment strategy tool that we use for investments 15, 20, 30 years. This is what Warren Buffett does, dollar cost averaging. It is the specific value of stock on a specific date with a specific frequency. I'm going to buy $300 of XYZ stock on the 15th of every month. The good side about that is it mitigates the bull market loss because we're buying it as we're moving down, which means we're going to capture some of that down cost, the cost of that stock at the lowest, which is over time going to lower our total cost for all the stock, the average cost. It's going to lower all that. That's the good side. That's the one good thing about dollar cost averaging. But the bad things about it are, and this is where most people trip up, it requires discipline. It requires something you can use. If you've got a trading platform, you could certainly use that automatic buy feature that a lot of them offer. I'm going to buy X amount of stock on the 15th of the month every month, and I'm going to spend X amount of dollars. That's fine. That is a great way to do dollar cost averaging, but most people won't do that. The other bad sides, this causes, because you're always buying, it causes the portfolio to grow at a slower rate than you would if you're buying with a logical reason. If you have a specific reason to buy, again, I'm not saying XYZ is an alphabet stock. I'm saying XYZ as any general stock. You're buying it because you need to with a regular growth in mind. And that's something that with dollar cost averaging you can't predict. You also, with the biggest problem that I think that happens is you'll end up missing bull market runs, and that's a problem because a lot of the gains, like we talked about a few minutes ago, we talked about the S&P over 20 years, that we had 3 years of that 20 years where the market just absolutely tanked, and that if you were in the market in those times, that it really, really hurt your long-term performance. That's why you only had a 5.9% growth. Well, that also means that if you're doing dollar cost averaging, you're not going to capture the big gains that helped engineer that 5.9% average over 20 years. And if you're not capturing the big gains, then your performance is probably going to be less than 5.9. All right, so that's dollar cost averaging. And one of the tools that's an opposite tool of dollar cost averaging that we use here It's called Sequence of Returns Risk Management. And that's what Drew was talking about just a few minutes ago, talking about using an annuity. And the annuity, the interesting thing about annuities is kind of like an option contract. You have a strike date. You have a date at which the annuity starts running. That's where an index, the value of that index is the starting point. And typically annuities are going to have a 1 year or a 2 year, or in some cases a 1 month date where they're going to look at the value of the index, and then they're going to add money to the value of your total value. They're going to add indexed gains to your value, to your nest egg. And if we can separate that risk out, so the problem is, I don't know, use $100,000 as an example. If you invested $100,000 into an annuity in January of 22, then you would have lost more than 19.6% for the entire year of 2022, and you would have eventually come back up to where the total indexed number was 19.6% lower than where you started, which means in an annuity you don't lose, so you would not have lost any money, but you wouldn't have made any either. So in sequence of risk management, what we would have done is we would have taken 50% of your $100,000, invested it in January, and 50% in February. And in that example, and this is a real-world example, in that example, the 50% in January would have performed the same way. Down, back up to a point where it's minus 19.6%, meaning that your gain was zero and you never lose because it's an annuity. But the 50% in February would have captured 16% of that upward move from when it hit the floor, which means your February annuity would have had a 16% gain. And when you take the same amount of money, $100,000, take the same amount of money, then all of a sudden you're in a position where your January investment didn't make anything, didn't lose anything, but didn't make anything. Your February investment made 16%, which was half of your total invested amount. The average gain for your two annuities there would have been 8%. And that's sequence of returns risk management. And that's something that we try to do here for people that have a large enough nest egg to invest. We try to distribute the risk so that we don't have to worry about trying to time. Anybody who tries to time the market is silly. Nobody does it. Nobody does it correctly very often. And you'll hear some people that have big wins, years and years in a row, and all of a sudden now they're not doing it anymore. Why? Because they had 1 year where they called it wrong and they got pushed out of the market. So it's a fool's errand to try to do it yourself. And that's the difference between dollar cost averaging, which is a long-term management of risk with level gains, getting rid of the up and down, just kind of having a slow level gain, slow and steady. That's the dollar cost averaging perspective versus the sequence of risk management perspective, that's where we're looking at a faster return because we're not waiting for the market we're not buying every month on a specific day. We're just dividing it up to have these programs start with indexes on the same day where we're going to call it right if we're doing a unit of 12 of these. If we're doing 12 separate indexed annuities that are all of equal size, that's a perfect distribution. Then we're going to call it absolutely perfect one time. We're going to call it absolutely wrong one time. And then we have the decision later on when we start taking the money, we can take the money from the programs that won well. And that way we're not really hurting the total nest egg and let the ones that didn't have the gains we wanted them to, leave them alone. Let them grow a little bit more. Let the plant get bigger. And that's kind of those two pieces. Drew, you got something?
Yeah, I got a question for you. So
Sure.
What about those who say, I've spent some time burying my head in the sand, making all these investments, right? Like right now, I don't even want to check. But you mentioned a nest egg.
Yep.
So where might they find these nest eggs?
Well, this goes back to, all right, so there's a couple places. So first off, if you've got money or you are investing money into a TSP or an IRA or anything like that, and you're not receiving a company match, it's worth having a conversation about whether or not those monies could be reinvested somewhere else instead of having it go to a tool that we know is not what it's cracked up to be. This is not me talking. This is Ted Brenna, the guy that invented the 401k. if you have an opportunity to go someplace else where the money, especially your unmatched money, could maybe perform better, or maybe you could have access to it earlier than 59.5 like you are with your 401k, then maybe you should do that. And that's what infinite banking, that's what that class next Thursday is about. Other places where people are maybe spending or saving money inefficiently, maybe life insurance, for example. All life insurance companies are not created equal, and all life insurance products are not created equal. So maybe you should do an evaluation. Is the life insurance that you took out 6 years ago, that you took out for a specific reason, still something that you need, or you need it in the same format, or maybe you want it to do something more for you? Maybe the death benefit isn't quite as much of an importance to you now, and really cash growth is more important. I don't know. So that's worth those conversations. So that's the second place that we typically would find places to help fund these other vehicles. The third place would be any place where you're spending money inefficiently. So that would be something like you've got a mortgage and you're doing a double mortgage payment every month to try to pay that mortgage down fast. In the end, will you pay the mortgage down faster? Yeah. Is it the smartest way to do it? Absolutely not. And there's another thought process, another tool that we can show you to do the same thing. It'll still pay the mortgage down rapidly like what you're doing. But what if you could pay your mortgage down? Say you have a $200,000 mortgage and you're making extra payments so you can pay it off in 10 years. And so those extra payments, if we could still do it and pay it off in 10 years, in the method that you're using, you'd have the mortgage paid off in 10 years and you'd have 100% equity in the house, but that's it. In the method that we would teach you, you'll have the mortgage paid off in 10 years, you have 100% equity in the house, and you'll have about $120,000 liquid capital that you can do whatever you want to do with. Which one's better? So it's an obvious choice. It's just most people don't know about those tools, and that's something that Drew and I specialize in. Is that where you wanted me to go with that, Drew?
That is absolutely the direction I wanted you to take it in. So I thank you for that, because I want people to know that we do specialize in finding money and helping and making things possible. And a lot of people think, well, that sounds nice, but I don't have $100,000 just sitting in the bank. And so it's important for them to know you don't have to. That's our job.
Yeah. Yeah, we'll find the money. All you have to do is
pick up the phone, right?
Yep. Yeah, there's one thing. I was talking to a client last week about this, and real quick because we're short on time. But the thing was, when we went through his analysis, he only had like $20 or $30 a month that he was spending or saving inefficiently. But you know what? It still worked. Even at $20 or $30 a month extra, just repurposing some stuff here, repurposing some stuff there, with $20 or $30 a month, we got him out of debt in less than 10 years, 7 years. And he'll have about $260,000 available to him in 10 years to do whatever he wants to do, plus he'll be debt-free. And he'll be ready for retirement.
That is magnificent.
There you go. What do you think, Lee?
I think call Scott Forehand.
Yeah? What's the number?
Number 757-278-1264. That's 757-278-1264. If you're outside Hampton Roads, that would be 1-800-677-0989. Visit them online, forehandagency.com. And don't miss Scott's class coming up on Thursday at 5:30. More info on the website or by calling them. Scott, always good to see you. Drew, nice to meet you as well.
Yep. Thanks a lot, Lee. And we'll be back next week, I believe.
Sounds good to me.
Thanks for having me.